Hi, everyone. Thanks so much for joining us this Thursday afternoon for a live webinar. I'm Leah Kolich, an investment counselor here at Real Wealth. And today I am presenting you a fundamentals class. We've been keeping a finger on the pulse of real estate during the COVID crisis. And we've gotten a lot of new investors joining the network recently. So we decided it's time to bring it back to the basics and kind of cover some fundamentals as people are getting out of the stock market, trying to take advantage of super low interest rates and start their real estate investing career. So excited to have put together this presentation for you, and I hope you get a lot out of it. So if you've watched our live webinar content in sequential order, you've probably noticed that my background is evolving. I just completed a big international move. My husband and I moved from Bogota, Colombia to Boston, Massachusetts. This is where we'll call home for the next little bit. So yeah, you've seen me go from home to hotel to new home. And now you can keep track of my unpacking progress and how I get it all put away. All right, so we will get right into it today, but before we go in, I'm going to tell you about some upcoming content that we have. I just recorded a brand new market highlight series with our Houston property team yesterday. And so we're in the editing process of that and getting it all posted to the investor portal. That content will go live this weekend. So Houston will get a little feature in our weekend newsletter, and then you will have a brand new market highlight video series there for you to watch. So it was great. Houston's one of my favorite markets, so be sure that you check out that webinar series. And then I decided to break this fundamentals class into two sections. As I was writing out this curriculum, I felt like we really needed to break it up to give ourselves some time to digest the information. So next Thursday, same time, same place, we're going to host part 2 of the fundamentals of real estate for real estate investors, and we're going to get a little bit more into tactical information, next steps, and application. So be sure that you register for that. We should get the registration going out this weekend, and you can always register on the investor portal. Our disclaimer. So the strategies that we're going to talk about in this presentation are not necessarily appropriate for everyone. There are other options that we won't talk about that might be more suitable for your specific situation. So you need to consult your personal accountant, tax advisor, and/or attorney to discuss your specific situation. I am none of these things. Past performance is no guarantee of future results. Real estate purchases are, of course, subject to investment risks, including the possible loss of amounts invested. So while I have made every effort to make sure that I'm giving you accurate information and current information, the possibility of errors and/or updates exists. So take my word as just another investor sharing my experiences with you and teaching you some of the things that I've learned along the way, but not a financial expert, a CPA, attorney, you name it. All right. With that out of the way, I want to give you a little bit of an introduction to who I am and a little bit about my background in investing, because I feel like that helps if you can understand where I'm coming from. So I am an investment counselor here at Real Wealth Network, but I'm also a real estate investor. So I was a part of this network as an investor, just like you, before I came to work for the team. I'm married to an active duty Army officer, and his career has afforded us the great opportunity to live all over the world. We spent time living in South Korea, we spent time living in the Netherlands, living most recently in Bogota, Colombia, and have just had a really wonderful experience. And really, I think our military career was part of the reason why we began investing in real estate. We bought our first home about 10 years ago, and we bought it to live in. We did some simple math and realized, hey, we can rent this house for $950 a month, or we can buy this house and our mortgage payment is only $750 a month. So, and that was about it. That was about all the analysis that we really did. We had access to a VA home loan, which meant that we could get into that property with no money down. In fact, this was right smack dab in the middle of the last recession. So there was even some incredible tax credits for first home buyers during this time. So we actually got paid $8,000 to buy our first home that had a little bit of positive cash flow. And we moved soon after. We were only in that house for about a year, kept it as a rental property, and continued to kind of follow that process of just acquiring properties where we lived, turning our primary residence into a rental. And then I would say it was about 10 years into my husband's career, about the halfway point before he could reach retirement, that we started really looking at our investments. We had subscribed to kind of the traditional retirement plan of maxing out 401ks and IRAs, and then really realized, hey, like, we're about halfway done with this military career. And if we wanted to, we could maybe really retire. We want to really retire in another 10 years when he can draw that military pension. But when you look at what that pension would give us, it wasn't enough to really give us the kind of lifestyle that we wanted to live in retirement. So we started saying, we need to do something. We need to do something to increase our income, our passive income. So that's when we really went back and looked at those investment properties that we had bought by accident and said, hey, imagine what we could do if we got serious about investing in real estate and buying homes as investments from the beginning. And so that's what we started to do. We had actually done a live and flip in North Carolina, which we enjoyed so much. We really liked the creative outlet of it, and we really liked the fast cash that it gave us. But we very quickly realized, hey, this is our opportunity to get all of this capital reinvested into cash flowing real estate. So we started looking for how to do that, and originally relied solely on ourselves. We moved to Europe and we started doing renovation on a distressed property that we bought. We bought a foreclosure in a market that we already had experience in, and oversaw that renovation from long distance. And it worked, I'm thankful to say, but it was risky and it was very time consuming. And so we had this idea of, hey, imagine if I could buy a property that somebody else bore the risk of the rehab, but then also was willing to sell it to me at market value so that I could really take advantage of full leverage and only be 20% invested in the property instead of also having to invest in rehab costs. So we started looking specifically for the turnkey model, and that's what actually led us to Real Wealth Network. We were, again, living in Europe, found the network, just really poured ourselves into education and really understanding the fundamentals of how this worked. And we scaled very quickly, and we went really deep in a bunch of different markets through property teams, through Real Wealth. And so that's a little bit of our background. We continue to invest. It's become, definitely a hobby, and now coincidentally my career as well, and sharing this information with you. But that's a little bit of background on how I got my start investing in real estate. And it's kind of what led me to the idea for this topic. I believe that real estate is one of the best ways to build wealth. It has consistently been one of the highest performing investment asset classes out there. Homeownership is cultural. I feel like it's a part of the American dream. We've all kind of subscribed to this idea that the end state or the ultimate goal is to own your own home and have it paid off. And to some extent, I think that that's a blessing and a curse. We're all kind of, I think, inclined to be okay with real estate, but I also think we're hesitant to think about it in terms of an investment exclusively. And so separating that idea of homeownership as my personal goal versus homeownership as a means, as a tool to get us to our ultimate investment goals, it takes a little bit of adjusting and certainly some educating. So that's what we're passionate about here at Real Wealth. We want to continue to raise the wealth consciousness so that people can create more freedom through the ownership of property. We believe that passive income gives us freedom of time. Suddenly our life becomes ours when we don't have to worry about clocking in at a day job. So that's what we're passionate about. I want to dedicate time today to really driving home the 5 different ways that real estate pays you. If you've had a conversation with other real estate investors before, you've probably heard everybody talk about, appreciation. That's kind of the low-hanging fruit when it comes to investing in real estate. Home values go up over time. But when you really start to, I think, realize that someone understands all of the different facets of real estate investing, they're going to think of each one of these items. So we're going to break it down. We're going to spend some time talking about each source of income in real estate investing, and we're going to start with cash flow. So cash flow, this is the passive income source. This is money that comes directly to you after you have paid all of your expenses of owning the property. In our case, including property management. So we're recommending that you work with professional property managers so that they can take care of the dirty work of owning the property. So to give you an example of cash flow, this is a very typical but hypothetical numeric amount. It's very easy to find properties at Real Wealth through Real Wealth teams that start at about $100,000. The average $100,000 house can rent for about $1,000 a month. You will subtract all of your monthly expenses, which is about $700, and that will leave you a difference or net of $300, which is your cash flow. A couple things to remember regarding cash flow. Cash flow increases over time as rent prices go up. So, you know, you can focus, and I see this all the time with investors, they hyper focus on cash flow goals, and they're analyzing tons of pro formas for today. But looking at what the cash flow potential is of a home today is negating what it will be 5 years from now, 10 years from now, 20 years from now. As property values go up, rent prices go up also. So over time, this cash flow value becomes more and more lucrative to you as an investor. The second point here is also really important to understand. That is that it's hard to create cash flow in high cost markets. So our buy box at Real Wealth is property that we can buy as a leveraged investor, meaning coming in with only a 20% down payment and still have that positive cash flow. So I'm going to use as much of the bank's money as possible and still create that positive cash flow. That's just simply not possible in some markets. Some markets, the purchase price of a home is extremely high. So even saving that 20% down payment could be a tremendous task. But then in addition to that, as property values go up, yes, rental prices go up too, but rent to value ratios get compressed. So rent prices will find their ceiling long before property values will. So I always tell investors there's this small window that you have as an investor, particularly an investor who is investing in a market that's likely to appreciate. That window of opportunity where you can come in with maximum leverage and create positive cash flow it's a limited period of time. That cash flow margin will start to diminish. The reason you have that opportunity is because you get to come in and lock your interest rate and fix your costs. So there is a little bit of a time situation that you've got to be aware of when you're talking of cash flow. So let's take a look at a sample property. So we stole this. This is a true sample property from one of our property teams so that you can have a look at it and see in kind of real-time numbers what kinds of cash flow returns we're looking at. So you'll see there's two columns on this pro forma. The first column is if you are coming in as a leveraged buyer with only putting 20% down. And the second column is if you're an all cash buyer. So let's focus first on that leveraged column. $125,000 house requires a $25,000 down payment plus some closing costs. So your initial cash invested is going to be just under $28,000. We've broken down all those reoccurring monthly expenses, $481 a month for your principal and interest, $210 a month for taxes. You want to include HOAs if that's applicable to the property you're looking at, insurance, and then property management. This particular property manager manages at 8%, so $96 a month to manage the property. So your total costs are $839 a month. Your rental income for that property is $1,195, giving you a net or a difference of $356. So this is pretty strong cash flow. For the year, you're right over $4,200 a month, which is awesome. On a $28,000 investment, that's close to a 15% cash on cash return. So I like what I see there. Now, a couple things that you want to think about when you're thinking about cash flow. This is a pro forma if everything goes perfect for that month. So if you have no vacancy, that's all sunshine and roses and not really reality. And then I would agree. I think maintenance and vacancy costs are a guarantee. So you definitely want to plan for them. And if you read that fine print to the bottom left, all of our pro formas include this, but we recommend that you set aside 3 to 6% of your rental income for maintenance and 3 to 6% of the rental income for vacancy so that you're prepared for those variable costs. But you can see there in the all cash column, your cash flow increases substantially. But what also increased substantially? That down payment. It required a lot more money invested to generate a little more than double the cash flow. All right, so the next way that real estate pays you is in principal pay down. So we've mentioned leverage and using the bank's money. I think this is one of the biggest reasons to invest in real estate and to get loans on the real estate that you buy. You've probably heard it said that you get to use OPM or other people's money. You get to use the bank's money. The bank is willing to give you a 30-year fixed rate loan so that you can go out and buy a property with only putting 20% down. And then you can rent it out to a tenant and have that tenant pay off that loan for you. So this is the power of principal pay down. It's not just that you have a mortgage and money is accruing there. It's that you have a tenant in your house paying that mortgage for you, indirectly, of course. But there's a statistic that I heard that said that on average, people spend about 20% of their paychecks on their living expenses, on housing. I read a more recent article that even said millennials can spend up to 50% of their income on housing. So what I love to envision is that for every house that I own, there is somebody getting out of bed, going to work, working a hard full day so that they can send me 20 to 50% of their paycheck. So for every 5 houses I own, I'm essentially working another job. That is money that is accruing for me. They're paying off that loan for me. Something to remember with principal pay down is that it can be slow at first. The banks have obviously looked at the math and they know that most people are selling their homes early on. They're not keeping them for the full 30 years. So they've amortized that repayment schedule, front loading all the interest. So because of that, the amount going towards your principal at first is going to be less. Not really impressive at first, frankly, but the longer that you own that property and the longer that you keep that mortgage, the further you get into some serious principal pay down where that money starts to accrue really quickly. That's one of the strongest cases I've heard for people who advocate, not necessarily refinancing, but keeping a loan for a long period of time so that you can get into that really efficient principal pay down portion of the mortgage. So principal pay down. The second way that real estate pays you. All right, the third way, this one I don't think is thought about as often, but I think it's particularly applicable right now, given where we're at in our world, where the government is just printing money and handing it out. I love that graphic there, this picture of an inflated US dollar. It looks really nice, it looks bigger. It felt good to have that stimulus check come into our wallets, into our bank accounts, but if we squeezed it, it's full of air. It's not real value. In fact, as more money is printed, it diminishes the purchasing power of that $1. So there's 2 different things you should think about when you think about how buying property creates a hedge against inflation. The first one is think about the debt. So you have a bank that is willing to give you a 30-year fixed rate loan. So we know over time, as the value of the dollar is eroding, that debt that the bank is giving you is also eroding as well. So tomorrow's dollars, it's going to be equal a lot less. They're not adjusting how much you owe them with inflation. It's locked on what the dollar was worth 30 years ago when you bought it. So that's the first way to think about it. The loan, the debt that I have is eroding with inflation. Now, on the other end, as inflation increases, the value of assets goes up. It requires more of those inflated dollars to buy the same property. So I think that's just so cool that there's these 2 really powerful ways that inflation actually helps the real estate investor, and particularly the leveraged real estate investor. So I've got a couple graphs here to kind of demonstrate this. So this blue line here, this represents the median home price over time. So you can see it goes back all the way to the early 1950s up until 2019. The second line, that orange line, is adjusted to inflation for today. So this is today's dollars, what that home is worth. So you can see, yeah, the dollar today is way, way stronger, or it doesn't buy as much, if you will, than it did before. And I pulled out a specific date so that we could illustrate this point even further. The average home in 1990 cost $97,024, and there it is. So sad. If we were to adjust that price for today's dollars, what would it cost? So looking at nothing else, not looking at appreciation, not looking at forced equity, which obviously from the pictures, this person did a great job renovating. There's absolutely going to be some forced equity in that home. If I'm just looking at inflation only, this property would cost $195,000. So we more than doubled the value of that home just by inflation. So owning a real asset is the best investment against hedging yourself against inflation. Number 4, the tax benefits. So this one's pretty great. I think this one is talked about pretty frequently. I've got 3 kind of different primary tax benefit categories. The first is deductions. Again, I'm not a CPA. I use a professional CPA for my real estate portfolio and for filing my taxes. I've told people before, you know, I also go to a dentist when I need to have a tooth pulled. I could probably pull out the tooth myself. It would be a little more painful. It would probably not be done properly, but I could probably do it. And I feel the same way about taxes. I hire a professional to take care of that for me. And these are just some of the deductions that if you own investment property, you get to take. So again, you might not be eligible for all of these. You definitely want to consult with your CPA to find out what deductions you could take, but you can deduct the mortgage interest, property taxes, insurance, maintenance costs, repairs, professional fees. So if you go and become a licensed agent, you could deduct your fees to keep your license. Education, if you're buying books, if you're attending classes, and travel, if you're traveling to go to education events, if you're traveling out to a market to go visit, to go pick property or to go visit the property that you've already purchased. These are all expenses that you might be able to deduct and lower your tax liability. So the second tax benefit is depreciation. So while we know property values are actually going up over time, the IRS has said that they think a house is worth less and less over time. They recognize that it's aging and that you're having to replace things. And so they've said the typical lifespan of a home is 27.5 years. So what they allow you to do is take the total market value minus the land that the home is on, divide it by 27.5, and you can deduct that amount each year, as that home, in their eyes, is losing value, though we know that's not really the case. So this is a great advantage, is being able to claim that depreciation. And then this is a wonderful tax benefit. This is an extremely powerful tax benefit, the 1031 exchange. And I got to tell you, I was talking with some foreign investors the other day, and we were talking about the idea of, you know, shifting from an appreciation play and then later in life switching to a cash flow play to have a little bit more efficiency when you need that money to live on. And they brought up, well, what about the capital gains tax? And through our conversation, I mentioned to them that in the United States, we have a tax code, the 1031 exchange, that allows us to defer the capital gains tax. So I'm not going to get too into the weeds on this, only because it's a webinar all in of itself. In fact, we just recorded an update with one of our favorite 1031 exchange facilitators about 2 months ago, and it's posted on the investor portal. So you can get way more details on the 1031 exchange, but this is really a powerful strategy. I think you might have heard me mention about the foreign investors that I was speaking with about this challenge of wanting to sell a property that has appreciated, but having this big problem of, I've got a ton of capital gains tax. I don't want to give the government this big portion of the return of the investment. And the U.S. tax code under the 1031 exchange allows you to sell a property, an investment property, and defer the capital gains tax so long as you keep that investment or that capital invested in a like-kind property. So this is an amazing tool. This is how I think wealth is passed down to generations. You can continue to defer that capital gains tax until you die, and then leave your portfolio to your heirs, in which after you pass away, that entire portfolio of property that you have been deferring that capital gains tax on for maybe the last 30 or 40 years, it steps up in basis at your death. So this is a really, really powerful strategy. Again, if you want to get some additional information on the 1031, you can check out that extended webinar.